And joining us now to break that down further is Venu Krishna, Barclays head of U.S. equity strategy. Venu, it's great to have you here. As you've just been parsing through Q2 earnings, what's been sort of the headline for you? What stuck out?
Yeah, so I think at the two-thirds rank, when two-thirds of the market cap has reported, the news in the aggregate level looks pretty decent, right? So we're running, the breadth of surprises and the depth of it is wider than normal, which is good. In aggregate, sales growth is running mid-single digits, and earnings growth is actually faster than that, almost 8.5%. So what that's telling you that there is positive operating leverage in the system, which is very good. But I think once you start sort of getting deeper to see what the underlying components are showing, I think there's a significant bifurcation. And on one hand, you have big tech, which is, we almost, when we went to the sum of the parts approach to looking at S&P a year and a half ago, that's when we created this concept. That is just blowing numbers away, right? So once again, we saw, without NVIDIA even reporting, you saw earnings growth of 27%. You saw the magnitude of beat at 12 percentage points. And you also saw net margins improving by almost 200 basis points. That is a pretty stunning statistic for a group of stocks which are exceeding $18 trillion right now.
Well, and you highlighted in your most recent research now, you were looking at one chart that just shows the surprises, right, of big tech versus the other stocks in the S&P 500. And we've talked about this concept before, but is that part of what supports the consistent bid in big tech? Is not only do they surprise, of course, they surprise more than the rest of the market, right?
That's part of the story. But I think the tech story is very, very interesting, and we've spent a lot of time thinking about it. So for example, the standard refrain and the concern of people that they're very expensive, right? So on an absolute basis, that is true. But if you look at the trend over the last 2 years, their multiples actually have been steadily declining, moderating. On the flip side, their earnings have remained quite strong. So they've moderated from extremely high levels. They were printing in the 40s percentage growth, now to in the high 20s and 30s. So what's happening is they continue to grow into their multiples, and the street has been consistently underestimating their earnings power. That's why quarter after quarter, we have been a lot more positive on them. And I think since Q4 of 22, when they had bottomed, they were just recovering, that's when we went very positive on that. So that story is very intact. And what's even more interesting in that segment of the market is people are pointing to this dichotomy between them laying off people and yet posting great numbers. And part of the reason is while the rest of the economy is waiting for AI's impact to be felt in a more tangible manner through either increases in productivity or how it affects margins or top line, big tech is already implementing it in their core businesses. In other words, what that tells us that if you are a tech native business or you're a tech centric business, chances are you're already seeing the impact of that. And the reason is quite simple, because one thing we know based on what companies have told us, which are very tech centric, the software productivity has improved 30 to 40%. So that is literally taking out layers of software costs out of your business. And if your business is centered around that, it makes a huge difference, right? So, you are right now in the middle of two mega trends. We were already in a transition towards cloud.
Right.
On top of that, you have AI. So this potent combination is going to be with us for the foreseeable future, and it's happening faster than the previous cycles.
And you mentioned something interesting there, and Steve, I want to get your take on this in terms of earnings season broadly. We've seen bigger moves for stocks, whether they miss or beat or split, right? Stocks are moving more than normal. What does that tell you about where the market's at right now and kind of the market mood? And I don't know if there's any specific ones you've sort of been watching that have stuck out to you. But.
Well, actually, I happened to do some work on this just the other day. And basically, I was looking at it not so much from Venu's point of view of were the numbers better, it was were the reactions better.
Sure.
So again, with about 2/3 of the S&P 500 by weight reporting, more stock, it was like 48% by weight were down as opposed to up, and that's been consistent. So in general, it's telling me that the markets have priced in a lot. but they love surprises. So Meta, Microsoft, they loved them because when you have this giant company that could surprise on the upside, they loved it. Although Alphabet surprised on the upside, and we got what, percent out of it. So I think in general, the smaller components of the S&P 500, which by the way is extraordinarily top heavy. There's 400 or so components that have like 0.1% or less, give or take, 0.2% or less, give or take, and you saw some more extreme moves on those because I think just the ability to surprise was greater because there's less focus upon them. There's less, when I look at the big companies, the options market's priced in the moves dramatically for all these. And some of these smaller companies, there's just less money priced in, so there's more room for surprise.
And the other thing that's been interesting too has just been the impact of, I've sort of been tracking this on a case-by-case basis, but the rally you've seen in the stock off the bottom and then how it sort of trades right after, right? You think of AMD comes out about inline print. I don't think there was a ton to really hammer them for, but the stock fell 9%. It had been up 45% going into the report. Yeah. And so I think you're just seeing maybe investors be a little bit more scrutinizing at this point in the rally. We're near record highs.
I think in some cases we've outkicked the coverage, so to speak. And so that's what happened with AMD. But then considering the market's love of buying dips, can't miss a dip and can't miss a rally that's to be chased, AMD got much of it back today.
Yeah.
So, again, the market is just looking for these buyable dips and jumping in. Over the past week, prior to Tuesday was the last time I looked at the numbers, the most bought stocks on our platform were UNH and NVO on a net basis. So
United Healthcare is down 50% this year or something like that?
And it was just after their latest reports.
Yeah.
And so, I do have to wonder when, trying to buy a dip becomes trying to catch a falling knife. But it's very emblematic of what we see. So even the dips are getting bought very quickly, even if there are disappointments in many cases.
And Venu, let's round this out with sort of your macro outlook into the end of the year and maybe, I don't know, beyond that, right?
Yeah.
The next 12 months. Do you think this can continue, this sort of vibe that we're having in the market?
I think it can, but I think there's a nuance to that. In the short term, we wouldn't be surprised if there's some choppiness, because one of our concern has been that the market has got too optimistic and has moved up too fast since bottoming in the post Liberation Day announcement. And I think if you look at other parts of the market, obviously, our team does equity-linked strategies. So one of the things we have created, and I think we discussed it once in the past, something called the Equity Euphoria Index. And the idea was to look at liquid options market and to try and see what proportion of a fairly large universe of 1,000 stocks are exhibiting euphoric behavior. And till recently, till the NFP print, that number was at 13%. And that was more than double the longer term average. And we're talking about the averages going back to the 90s. So there's a significant portion of the market in which the level of optimism is running very high, which sort of concerns us. And then see what happened with the NFP print came. In other words, the market became less and less macro sensitive. And then all of a sudden it became very, right? So if you look at what the options market were pricing going into the NFP was moves broadly inconsistent with long-term averages. Sure. In other words, no big surprise. Well, you got a massive surprise on the downside.
Right.
And so things have moved. So one of the concerns I have is we are a fully valued market. We are not saying it's rich. In fact, the part of the market outside the S&P is where we have more concern, because that is where the earnings growth is actually running weaker than long-term averages. Going into this print, numbers were cut more aggressively than long-term numbers, though they were not cut bad enough to mirror what you typically see in a shallow recession as well. So, but I think the second leg to it, why we remain optimistic, is that I almost feel that this year has been completely dominated and taken over by the scale of policy uncertainty. On top of that, you got geopolitical risks, which cropped up again.
Yep.
Now you're past both tariff uncertainty and geopolitical uncertainty. And as we enter next year, in a world in which we expect economic growth to moderate but remain better than this year, where consumption improves but is worse off than pre-pandemic averages, and where inflation sort of eases into the right direction but remains sticky. In other words, higher than what the Fed expects. in such an environment, we still estimate earnings will be up 9% next year. In other words, accelerating from where we are this year. And if you look at consensus, that's looking at 13 to 15%. I think that's way too optimistic. But for all the chaos, the underlying fundamentals are decent. The one big sort of uncertainty, which we said, this is the first quarter we said, where you'll start seeing initial tangible signs of tariff impact. Right? And where will we feel it more? We felt that is going to be visible in the consumer-facing segments, which is discretionary, staples, areas like that, and some other areas like industrials, for example, where. And so we're already collecting data. We're doing work on that. Looks like industrials are able to handle it better, at least in the short term. But the consumer-facing segments are already facing trouble. So some of them are already in a pickle because they raised prices enormously after COVID. Remember, COVID was a one-time opportunity to raise prices without fear of a competitive reaction. So that fattened your bottom line. Companies are in great shape. But now you're running against demand inelasticity, or the elasticity of demand, right? And so if you thought it was becoming more inelastic, that's not the case, because the consumer is on the margin under pressure depending on what cohort you're looking at. The middle and the higher income are doing fine. That's why those consumption patterns are great. But as you go lower, then they are making choices. Because in aggregate, if you think about it, prices have increased 30-40% in aggregate after COVID, right? Your wages haven't increased at the same pace. So even though inflation is coming down, the accumulated impact of price increases does bite. Home prices still are up 30-40%, even as we said, even as we talk about the housing market being sort of weak right now, right? So I think a lot of post-COVID normalization and the impact of some of the massive policy changes we are undertaking, and the fact that outside of financials and tech, right now, most sectors are actually earning less than the long-term averages. And three sectors, in fact, I think it is materials, it is utilities, and energy, they're going to see earnings contract.
A trend we got to keep watching.
Right? So this is not as clean as it seems. But when you keep talking about aggregate, that's why tech is so important. It keeps bailing out the market, and it remains on a very strong. But you wonder that when do the law of large numbers start kicking in at these levels? Or are we going into a world which will become highly concentrated, in which the earnings power and their breadth of businesses is truly massive and very difficult to dislodge.
It's a trend we're going to keep watching, Venu. We got to leave it there. I appreciate you coming in the studio today. Thank you.
Thank you.